Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is Dave Maza, CEO at Roundhill Investments. We are talking about the Mark 7 red hot memory stocks, a new memory ETF, and a few very interesting corners of the market. Dave, welcome back. Thanks for joining us today.
Happy to do so. Thanks for having me.
So you recently launched the memory ETF DRAM, and this has quickly become one of the hottest new ETFs of the year. So this ETF made its debut on 2nd of April. So it's barely 2 weeks old, and it has already gathered close to $1 billion in assets. So let's start with memory stocks, and just to set the stage for listeners who may not have been keeping up with these insane moves, SanDisk is up about 2,780% over the past 12 months. And this was spun off from Western Digital in February. It was added to the S&P 500 index in November last year, and now it is being included in the NASDAQ 100. Other names have also surged. Micron is up about 570% over the past year, Western Digital 920%, and then there are South Korean stocks, SK Hynix and Samsung, which have also skyrocketed. And this rally is being driven by concerns about a potential shortage of memory chips, which are critical inputs for AI data centers. So tell us what's behind the surge in memory stocks.
Yeah, and you hit a lot of the important points. So for those who aren't as familiar, memory stocks are companies that make memory chips or memory semiconductors, which is a specific corner of the semiconductor market. The memory chips are used in almost everything. We'll talk about AI and the growth from data centers in a moment, but they're used in your smartphone, a smart TV, in your car, if you have a smart refrigerator. They're very behind the scenes. And what's changed with memory is it was historically a very cyclical business. You saw these boom and bust cycles really driven by either a new technology, a new use case, and there was often associated with that overbuilding and then underbuilding, causing these boom busts. It takes a long time to build a new semiconductor factory. But what's really changed is because of the growth of AI and the data center demand, data centers in 2025 actually accounted for 50% of global consumption of DRAM, which is a type of memory chip. It stands for digital random access memory. And so the AI build-out has created something the memory industry had never had before: sticky, really non-discretionary enterprise demand. And what's also changed is that boom bust cycle is really no longer as relevant because these chips are in such short supply and such greater demand. Companies are now actually signing longer term contracts to source these chips, which had never happened before. So the stocks have really rallied in anticipation of this, and the idea that, according to many researchers, whether they're from sell-side investment banks or industry research, that actually the shortage of memory chips is going to extend well into 2027, perhaps into 2028. And that sticky demand is causing a spike in revenue and earnings from these companies.
So these stocks had pulled back late last month after a report that Google may have developed a technology and algorithm that reduces the amount of memory which is required for these large language models, LLMs. So I was curious in your thoughts on how Google's new approach may impact the outlook for memory stocks.
Yeah, if we recall back to last year, we had the DeepSeek moment, which impacted companies like NVIDIA. And the Google's Turbo Quant algorithm actually had the same impact for a short period of time for memory. And really what that was in our opinion, a overreaction where the market was really just reading the headline and not the broader points. And so what Turbo Quant was doing was really compressing a certain stage of the working memory that's needed for inference. But it doesn't actually change the requirements for model training, which is the stage that we're in right now. As companies are rapidly building new models, of course, Anthropic seemingly has a new model that's disrupting another industry on a daily basis. So that was a bit of a overreaction driven by the potential for longer term needs of memory to be smaller than they really are going to be now. The other interesting thing is the flip side of that is there's a term called Jevons paradox, which actually means when something gets more efficient, you use more of it, not less. So if Turbo Quant is actually helping an AI model run more efficiently, it actually doesn't reduce the amount of chips that are needed to train the next generation of models. And that's where order books for companies like Samsung, SK Hynix, and Micron are already set. So I think, in short, it was an overreaction based off of the potential for there to be disruption. But in the near term, Turbo Quant does not change the demand for memory.
Excellent points. Now, investors can get exposure to these areas either through chip ETFs, though not all of these stocks, or even country-specific ETFs like South Korea ETFs. So what gap did you see in these existing ETFs that led you to launch the DRAM ETF?
Yeah, no, it's interesting. And sometimes when you're thinking about new ETF launches or new ETF exposures, you're often thinking about something which is maybe in the future or coming. What's interesting about memory is that it's actually here and now, and these stocks have, really been picking up for some time. But when we were thinking about what's the best way for investors of all shapes and sizes to access memory, there wasn't really a great means of doing so. So to your point, there is, of course, large and liquid semiconductor ETFs in the market, many of them, but most of them don't have significant exposure to memory semiconductors. And in the US, thinking about the big three, it's only Micron. But the two other largest companies are Samsung and SK Hynix, which are South Korean listed. So an investor would need to use a South Korean ETF for exposure to those companies. There wasn't anything that actually precisely packaged both the US listed memory companies and the South Korean memory companies. And so really what DRAM offers is a precision tool for investors to be able to implement that exposure in their portfolio without needing to maybe take on excess risk if that's not really what their intention was. So even though Samsung and SK Hynix make up a significant portion, of the largest South Korean ETFs, you're also getting a lot of financials and industrials and more cyclical businesses, and that may be a good trade. But if that's not what you want, it's an inferior exposure. So DRAM really solves that problem.
Excellent. So tell us a little bit more about this ETF. It has a very concentrated portfolio of just 10 holdings, and we know that there are certain diversification rules. So that is why it uses derivatives. So tell us about the methodology.
DRAM is structured in a similar way to our Magnificent 7 ETF, where the precision, the concentration is done intentionally so that we can provide the best means of exposure. There's just simply not that many memory companies. And the way this ETF is constructed is by creating that specific basket of memory stocks and storage stocks, and then using a modified market cap approach to implement that exposure. And today there's 9 holdings. And so that we can meet diversification requirements in ETF, we will use total return swaps to help kind of complement what we're able to do with individual securities. But really, the intention is to create that precision.
Okay, so you mentioned your MAX 7 ETF, the ticker symbol is MAX. Let's talk about that one. And we know that big tech stocks have struggled over the past few months. Your ETF MAX is almost flat year to date. So there were concerns about heavy spending by the hyperscalers and whether those massive investments will ultimately generate strong returns. And we may not know that for a while. And at the same time, there were worries about disruption in certain areas from artificial intelligence, the so-called AI scare trade. So Microsoft stock was a victim of that trade that was down almost 30% earlier this month from its recent highs. But over the past week or so, we have seen a pretty strong rebound in these big tech, the Mac 7 stocks. So do you expect this recent bounce in the Mac 7 stocks to continue?
Well, yeah, it's interesting. So if we take a step back to your point, actually, big tech, the Magnificent Seven, was really leading the market lower even before we got the conflict and war in Iran. So there was a rotation happening in the market where capital wasn't leaving U.S. stocks; it was moving toward more value-oriented sectors because of the concerns that you mentioned. And then the as the war began, that's when the broader market in all areas, perhaps outside of energy and materials, did poorly, as there was concerns about sort of worst case scenarios, especially with the impact on the price of oil and then inflation. But as good news regarding the conflict has started to come out and be priced in, the Magnificent Seven stocks have actually led the market higher and recovered significantly a good portion of their drawdowns. So what I believe is occurring here, and we've seen a significant amount of inflows into the MAGS ETF since the market has bottomed, is investors are concerned about that two-sided risk, meaning there's a significant number of issues related that still need to be resolved with the war in Iran. But at the same time, even with the concerns about spending, if we're heading into an earnings season where the Magnificent Seven is expected to sort of significantly outpace revenue and earnings expectations compared to the other 493 stocks in the S&P 500, investors don't want to be on the wrong side of that. So I believe that there's continued significant momentum heading into earnings season for the Magnificent Seven stocks because they were really sold off so aggressively and reached a bit of an oversold level. And of course, the proof will be in the pudding. But as we head through this earnings season, which has begun, but big tech comes in a couple of weeks, that's I think actually going to be a further catalyst for investors to recognize that certainly as the economy perhaps begins to recover from some of the impact that the war has had, these companies are still going to be stalwarts, even as they're spending significant amounts of capital. But funny enough, a lot of the capital that they're spending is going into the memory chips, which is one of the reasons why those companies have been doing so well.
Right. So the MAX ETF, it aims to equally weight the MAX 7, right?
Yes.
And we have been hearing some experts say that Magnificent Seven isn't a monolith, that investors should separate AI winners from potential laggards. So tell us why taking equal exposure to these giants still makes sense.
Yeah, no, we have certainly seen a bit of intra Magnificent Seven rotation where winners and losers have emerged at different times. And there's certainly a case to be made that the idea of sort of having equal weighted exposure no longer makes sense. But what I think is interesting is a bit of the flip side of that, where it's become really difficult to ascertain with great abilities who's going to have the best large language model. So the equal weighted approach that the Magnificent Seven does, which actually is on a quarterly basis consistently selling the winners in the Magnificent Seven and buying the losers, actually has paid off than trying to time whether a new model from Gemini is going to gain all the attention versus something from another company. So I actually think, even though we didn't see it to begin this year because of the concerns about spending, the idea that these companies can actually, because of their revenue growth, be not a traditional defensive, but have some defensive characteristics in a time of uncertainty is going to pay off for the group.
Yeah, I agree with you. It's very difficult to sort out winners and losers because we don't have much information as of now. We still have to wait who will emerge as the winner and who will emerge as a loser in this AI race. And I mentioned Microsoft earlier. This week, it has been up more than 15%. It has been one of the best weeks for Microsoft stock ever. So, yeah, having exposure to all these stocks, I think, makes a lot of sense. Now, I also wanted to talk about the meme ETF. You launched this ETF in October last year, and at that time, the market was pretty skeptical because its previous avatar in its previous life, the meme focused ETF, was launched at the height of the meme stock mania, and then it ended up being liquidated about 2 years later after stocks like GameStop and AMC plunged. So tell us why you think these stocks are worth investing in now, these meme stocks. And I was looking at the performance over the past week or so. This is up about 20%. So tell us what is going on with these meme stocks.
Yeah, one of the reasons why we decided to bring back the meme stock ETF is due to the fact that retail now makes up a significant portion of daily volumes in the US equity market. So before the COVID period, on average, retail made up around 8 to 10%. Today, it's around 20 to 25%. And on some days, they're actually north of 30. So the power of retail investors is very different than it was a few years ago. And while the meme stock ETF is not intended to be a core position, it should really be used as a satellite position. The idea is for investors to be able to capture a basket of retail sentiment focused on stocks that inherently have high volatility, that have high trading volumes, with the idea that retail, there's information that we can ascertain from retail, and over either short periods, as you mentioned, or very longer periods, those can lead to outsized returns, which we've actually seen on a year-to-date basis. I'll point to the situation that we saw with Allbirds, ticker Bird, earlier this week, when the company actually, it's a shoe company, but they decided to pivot to AI, and the stock was up well over 500%, close to 600% on a day. We actually own that stock in the meme ETF and have the ability to take advantage of that. And that really is, those opportunities don't come along every day, but the idea that meme could be used as a satellite position in investors' portfolios to take advantage of having an outsized return and not have to kind of pick those what stock is going to meme next is really the primary reason why we brought that ETF back. And on a year-to-date basis, I think we're seeing the idea that as animal spirits remain in the market, there's the potential for outsized returns from memes.
Right. Allbirds was an insane move from shoes to GPUs and that 600% surge. I saw that SNDK is also one of the top holdings in the meme ETF. Could you talk about the other top holdings which are doing quite well?
Yeah. So if we look at the basket today, I really also like to think about sort of meme thematically. SanDisk is in the top 10. That's a company which is actually in our DRAM ETF that has had outsized trading volume, outsized volatility with tremendous performance, capturing one of the tips of the sphere of the AI evolution. We also have a company, Planet Labs, in the portfolio today. That's a space-related company. We know how popular space stocks have been in anticipation of the SpaceX IPO, but also a very meme, sort of more value-oriented, kind of almost classic meme is Avis Budget Group. CAR is in the portfolio as well. So what investors will see with meme is really what themes retail is rotating in will be reflected in the stocks that are in the portfolio at any given time.
What other areas of the market or themes are you bullish on now?
Yeah, well, certainly memory, and I think we spent some time speaking about that. That's one that was not a theme that was not as really appreciated in the market. I think the idea of embodied intelligence, embodied AI, humanoid robotics is another theme that we're really beginning to see some massive progress being made on, not just with Optimus coming in the US, but also what we're seeing in China and Japan and Korea, where humanoid robots are making massive advantages. Other themes, like I touched on a moment ago, space is one where we really think about it kind of from a very big picture point of view and think about just sending astronauts to space. And not that that's not important and exciting, particularly the mission that we just had, but space is actually really important for the global economy with the growth of satellites. All the pictures that we've seen in recent weeks of the Strait of Hormuz and whether tankers are going through or not, that's coming from space. It's coming from satellite imagery. And as connectivity around the globe and the need for more satellites comes to market, the space economy actually is going to be one of the beneficiaries.
Excellent. Now, switching gears a bit, I also wanted to talk about your XDIV ETF because we have seen a lot of interest in these tax-aware ETFs. Tell us a little bit about this ETF, what it does, and who it is suitable for.
XDIV is one of our, in my opinion, one of our most underappreciated ETFs. The idea is that XDIV seeks to replicate the total return of the S&P 500. It does so at a relatively attractive net expense ratio of 8.49 basis points per year, but it intends to minimize ETF distributions. And so the idea is to create a superior after-tax return profile for investors. So it allows for some autopilot. So an investor can stay fully invested in the S&P 500 without the need to reinvest those distributions, and also potentially have tax advantages depending upon how those assets are held. So on one hand, XDIV is very, very simple. It is an S&P 500 ETF, but it focuses on delivering the total return, but by minimizing the ETF distributions to do so.
Excellent. We'll have to leave it there, Dave. Thank you so much for joining us today and for sharing your excellent insights.
Thank you for having me.
That was Dave Mazza of Roundhill. Let's quickly recap the ETF and stock tickers that we discussed. So the memory ETF is DRAM ETF. We talked about some of the top holdings in this ETF. SanDisk is SNDK. Micron is MU. Seagate is STX. Western Digital is WDC. We also talked about the MAX 7 ETF. The ticker symbol is MAX, MAGS, and it holds the MAX 7 stocks. And we all know I don't have to talk about those tickers. We briefly talked about the meme ETF. The ticker symbol is MEME. He mentioned some of the top holdings. Axis Budget Group is CAR, CAR. Allbirds is Bird, BIRD. And then we also talked about the no dividend ETF, Roundhill S&P 500 no dividend target ETF. The ticker symbol is XDIV, XDIV. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@saks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.